Hello, folks. Brandon Chapman with you today. It's another Monday video for Theo Night. Interesting day in the market today. As we're rallying towards the high of the session, as we kind of hear some of the news coming from the debt ceiling. Apparently, the debt ceiling discussion is starting to heat up as deficits are exploding, and the S&P has surged the most pre-earnings since 2009. So a lot of setup here for either a big move up or a big move down. We'll kind of address that as we go through the session today, as well as look at some stocks like Synchrony, Target, Chevron, Cenovus, Hewlett Packard, and Tencent, as well as some earnings that are coming up this week. All right, let's get going. So the S&P again was down a little bit. We are rallying. When you look at the range today, it's 28.54. So I'm going to bring up what's called an ATR. So this represents the range from high to low, or from the previous day's close to the next day's high and low. You'll notice down here it's about $50, so $49. So today's range, well inside that kind of one ATR range. And most of the trading days over the last little over a week have been very similar, with the exception of, for example, April 12th was close to 50, and April 13th was close to 50, and then Friday was around 50. So we've had 3 days that are about average in terms of the ATR, but the trend is to see tighter and tighter trading ranges, which makes a whole lot of sense given the fact that when you look at skew, which skew has been surging of late. Notice that yesterday we posted last Friday, we posted a 134. So again, anything above 130 would be high degree of skew. So what we're seeing is that as the VIX is coming in, guess what's happening? Skew is rising. What causes skew? Buying puts and selling calls, which is a hedge. So we've been looking for this idea. When do the hedgers at that 30-day time frame start to emerge? And you notice since we kind of troughed here on March 2nd, generally speaking, as we've seen the banking crisis rear its ugly head, skew has been rising. And what that means is what? It means that, yes, there's the tail risk, the large potential downside move that's being priced in with the skew at 134. But there's also the other side of it, the mode. The most frequent occurrence is a small up day. And so as we look at the market, expect to see a higher frequency of small up days as we start to build up the climb the stairs, fall out the window type of scenario here. Now, as we look at the SPY, notice 1.2 million shares traded. This is out of sequence, but 412.55. So again, as we look at this, notice today, again, 412.55 right in here, we've had a significant print. Now, this can act as a support level. It can also act as a resistance level. And so if we look at this intraday, was there any respect for that intraday level at 412.55? Not so much so. Like early on, maybe we slipped through it and then we broke through it. But just so you know, these oftentimes occur around significant inflection points, but not always. Here's one that occurred in the middle of a trend. This occurred at an inflection point. That occurred near an inflection point. This one occurred near an inflection point. And we could go back even longer if we wanted to, but frequently these large prints occur around significant inflection points. Now, again, we may have a little bit more to run. My expectation, we're probably going to test that 419 area, and that's been the case for a while now. As we take a look at the VIX, with the smallest trading range and the decline in the VIX, did it result in a lower VIX level? The answer is yes. So for the last week, I've been calling for the VIX sellers to start to emerge as the skew has been rising. Again, those smallish, more frequent up days pressuring the VIX as the volatility comes out of the market and the VIX starts to price in reality, right? And so as we look at this, we see the VIX is currently falling. Now, where does the VIX stop? Well, certainly back here on, for example, February 2nd, this was the low point on the VIX. But better yet, it's better to look at term structure. So what I like to look at is a ratio of the 3-month VIX against the 1-month VIX. Sure, I got it. Sorry. VIX 3M plus VIX. By doing it a plus sign, this creates a composite line here, both of them added together. That's not what I'm concerned with. I want to bring up what's called a pairs ratio study, which is in thinkorswim. It's a means of taking a composite symbol, and then what it does a ratio. So if we look at on Friday, it was almost about 118. We're dipping today a little bit to 115, meaning that the 3-month VIX actually dropped more than the 30-day VIX. So again, we're about 115, 116. What that means is we want to see this north of 120. So if we see some positive movement in a couple of days, next couple of days, this could very readily get back up here, and which means we may be towards the end of the rally as we're starting to emerge with some strength, and that strength usually putting in a top. Otherwise, if we do see the market pull back, and this will kind of decline here, and oftentimes maybe gets to 110 or something, it drops quickly, we may be setting up for even a bigger move or just a retest. But we're looking for this something north of 1.2, meaning the 3-month VIX is 20% higher than the spot or 30-day VIX. And this is what we're looking for to provide that bearish signal with skew above 130 to say, hey, now we're at a level that we should expect to see about 5 to 10% of downside in the coming weeks. And so right now, again, we're looking at the market continue to probably inch higher here. And as we look at earnings coming up over the few days, we're still dealing with very intensive bank earnings. Like, for example, BAC. BAC announces tomorrow before the market open. So BAC has been up a lot. Does it create bearish pressure because it drops lower, or do we create even further bullish pressure if the news comes out good? Now, we obviously went through Silicon Valley Bank. Bank of America was one of the most exposed in terms of unrealized losses relative to their equity. So that could be a big one tomorrow, but certainly the positive movement expects that probably the news will come out more positively. But when you get big moves like this pre-earnings, frequently you'll see smaller amounts of upside on a beat and more downside if there's a miss. So 3 things we look at: do they beat earnings? They beat revenues? Do they raise guidance and the stock price go up? What I will say with regards to banks and financials in general, we could throw utilities in the mix. It is harder to do fundamental analysis. So we'll kind of read the price and see how that is interpreted. Last Friday, we had JP Morgan that worked out pretty well for the bank. We had a Wells Fargo that was generally more positive. Citigroup, which was generally more positive, which a lot of the concern was with smaller regional banks. Well, today, for example, we had STT, State Street Bank. State Street is a holding company. Stock dropped a lot, finished down about 9%. If we look at Charles Schwab, again, this is a broker, but it finished gap lower initially, rallied towards the end of the session. MTB, this company, initial reaction was lower, but then rallied throughout this session today. So again, so far, I mean, with some exceptions, there hasn't been extraordinary moves in a lot of these companies. Morgan Stanley, another big financial company, is set to announce, I believe, Wednesday before the market opens. We have U.S. Bank, which is coming up, I believe, on Wednesday before the market opens. And then we got BK. They're set to announce tomorrow. Bank of New York Mellon had a lot of pressure today after some of the results that came out. So again, it's been a bit of a mixed bag. I expect to see more weakness or more volatility in regional banks. They're more lending focused. The big money center banks, those strategically important banks, money tends to flow up to them. But anyway, so we got a lot of stuff going on in the banking space, but we're about through it. And once we get through it, again, do we set up possibly for the market to make a run if we see pressure? Or again, financials may be up 1% today, may be the leader or one of them that carries the market to highs. One of the surprises today was the performance of REITs. They had a relatively large down day on Friday. We're basically making back that point. But when you look at treasury yields are rising today as interest rate expectations are kind of picking up a little bit. A higher probability of a rate cut in the next meeting, less of a chance of cutting rates by summer or by the end of summer. And so a lot of stuff kind of, uncertain at this stage. Real estate certainly is one of those where you kind of expect it to be more bottled up. A lot of concern about commercial real estate specifically. And so again, there's just been a lot of weakness in this space, but today was a really nice rally for the REIT space. But again, be careful, right? This is one that could really see pressure if we start to see the default cycle start to pick up, which could be pretty negative. If we look at GLD or GC, whatever pick your poison on that front. What did the dollar do today? One of the risks of the S&P is if the dollar begins to surge. When you look at GLD today, down minimally about 0.5%. So if we look at the SPY, which is priced in dollars, if the dollar strengthened by maybe 0.4 or 0.5%, certainly with the market up 1/3%, you add those two together, the market was a bit stronger today than what this is indicating. Same thing on Friday of last week. When you look at GLD, GLD had a rather bad day on Friday, which is illustrative of stronger dollar, which should drive down the market. But again, if the market's down by less than what the dollar's advancing, in real terms, the market's higher. And so you can take a ratio of the S&P to gold to kind of factor that in. But again, the market's actually been stronger the last couple of days than what the price is really actually telling us. And so again, if this dollar starts to weaken, that's something that could really cause prices to begin to move here in the next several days, maybe the next week, that may help us bring us into that bullish crescendo during the top. In the backdrop of all this, you're seeing, kind of one of the first real news stories about the debt ceiling. When you actually look at what's going on in terms of deficits, it doesn't look good. In fact, again, deficits are surging. I think we got about $1 trillion in deficits through the first 6 months. And this is likely going to get worse. We're going to get some tax receipts, how much the Treasury is taking in. But with the Fed losing money, okay, mortgage-backed securities, I think it's the first time they've ever lost money, in terms of but again, with the huge rise in interest rates, some of these mortgages are mortgage-backed securities are taken on the nose. I shouldn't say the first time, but the first time in a while. We're kind of at a point right now where there is very definite risk. The Fed is losing money. Those remittances that the Treasury normally expects, they're not getting them. And I've said this for a number of months. This may mean $1 trillion more in deficits this year. And so right now, for the first 6 months, we're seeing about $1 trillion in deficits. Certainly, we're looking to swell at least to $2 trillion. And if we start to see recessionary pressures even more, and this places added pressure on the debt ceiling. And I realize what was said back in 2011. Yeah, it was easy to say after the debt was downgraded, oh, it's because people wanted to reduce the deficits and say that. But the reality is that wasn't downgraded until we raised the debt ceiling and the budget was out there. And so from my perspective, yeah, it makes it easy for people that don't like the idea of cutting deficits and reducing spending to say that. I'm not sure that's actual real proof from that. The fact of the matter is the downgrade occurred after the debt ceiling was raised and the budget was proposed that saw really significant deficits down the road. So McCarthy and Biden are obviously the White House are going to have to negotiate along with the Senate as well to figure out what's going to happen. And McCarthy mentioned we don't want to bubble into it. And certainly we don't want to default. Now, here's a little news for McCarthy. We have defaulted in the past. For example, dollars were convertible at a fixed exchange rate to gold for U.S. citizens. FDR confiscated the gold and took away gold convertibility for U.S. citizens. In 1971, we suspended the gold window, and then we actually raised the exchange rate to like 33 from like $24 an ounce, devaluing the dollar by 70+% in the midst of a depression. 1971, we suspended the gold window and then basically shut it or closed it in 1973. All those that were holding on dollars had expected that they could exchange it for gold. So while we did not fail to meet our debt obligations, there have been pseudo defaults that we have had in order to finance our deficits and to create this inflationary scenario that we are currently in. And no wonder, there is some aspect to this wanting to basically not use the dollar anymore. Again, we've kind of weaponized it against countries like Brazil and other emerging market countries in the past. It's very hostile for emerging markets. But again, are they really going to basically turn their nose at U.S. demand for their products in the end? I'm not sure that's going to be the case. There's still tremendous amount of dollar denominated debt out there. Is that going away? No, not anytime soon. So what you do expect is if the market does start to see a little bit of a downturn or we start to see default, the dollar should strengthen against other currencies, like, for example, the Chinese yuan. Okay. So the reality is the dollar has more of a stronger bias in the coming months or longer rather than weakness. But we do have an event supposedly running out of money by June. It may likely come earlier as the deficits are getting wider and spending is clearly unabated. We're spending at levels we've never spent in the past. Tax receipts, at least up to heretofore, has been one of the best years we've had, and yet we're seeing massive deficits. So a lot of risk as we enter the summer, as we start to get through earnings season, which is now beginning, which will extend through the retail sector in May. Anyway, so a lot of interesting things going on. Oil /CL down a little bit today after some bullish. We'll get some more data on Wednesday. We look at the product depth here. The curve is flattening a little bit out here, but again, we're still, for all intents and purposes, in backwardation. The risk right now for oil is to the upside, but again, the dollar can definitely spoil the party for miners. So last week I outlined a number of miners like FCX and SVM and a number of these gold miners and silver as well that had some bullish option activity last week, SLV as well. So again, but right now what we're starting to see is that move is starting to reverse a little bit. And on Friday, one of the first bearish trades I've seen in a long time in the gold space on GFI. So if the dollar strengthens, expect to see pressure in gold and the market generally, and especially commodity stocks, gold and silver, precious metal stocks. We may see a bit of a pullback, which is necessarily healthy for them. Again, but if the dollar weakens, we may see the selling we're getting right now and see it reverse and start to move higher. All right, let's look at some activity that's gone on today. One is in Synchrony Financial, and I think that these consumer financial stocks are kind of interesting. Last week, it was earlier in the week, like PayPal, for example, some bearish trade on it. And then all of a sudden, things kind of flipped on Wednesday. The idea or the notion, maybe we see a little bit of squeeze in these financial stocks. And the last 3 days for PayPal has been pretty decent. Even an Ally, for example, it's been holding its own. But you're seeing people take some stabs. But that kind of changed today. So Synchrony Financial, while it finished near the high of the session, you probably want to have some sort of trigger. But they do have earnings coming up on April 19th before the market opens. So again, today in Synchrony Financial, it was an April expiration at the $9 strike price, $29 strike price. Again, a little bit out of the money, about $1. But the idea is, again, this creates kind of a level that if we start to break 29, this could really start to push hard as we squeeze towards 27. And you look at the expected move for the week, it's about $2.10. So we're currently at 30. Could we end up at 28? Absolutely, we could. So, you could try to structure a trade around that, using either a butterfly down here. We have classes at TheoTrade on how to set these up using the expected move, but a $2 expected move, we're centered around 28. So if there's any downside here, you could set up a butterfly pretty simply here. Buy deep and wide 1 month, probably about a 2-strike butterfly, cost you about 40 cents. So break even is shave 40 cents off the wings here. That's your break even range. And it's actually wider than that, until the vol comes out of it fully by the end of the week. So that's kind of targeting that 28-ish area between 27 and 29. So if we drop, so pretty cheap trade, relatively higher reward to risk. And you can see that if you go to analyze trade here, the risk profile, you'll see the upside here is 150, not going to be real. But if you can kind of get it in this range, you have a chance of, with volatility coming in, you might have a chance to risk 40 and maybe make 80, about a 2-to-1 in that circumstance. So again, an idea there, looking for the downside on the news this week. A consumer stock, Target, it got its breakout, it tested, and now we're testing again. We're holding in here. You might look at today's high, look for some movement above today's high. But it was if we look at the trade tab in here, it was the weekly option here, April 167.50, 16,000 contracts mostly bought. Again, it gives us kind of an expectation, also gamma level, looking for target to maybe retest the prior high at 171. And I realize that this is a bullish trade with kind of the expectation that we may angle more bullishly, and what stocks are likely to lead other than maybe more staples or consumer, staples oriented stocks, Target being one of them. Let's see another one here in Chevron. What about oil? Now, oil right now is certainly, the risk is to the upside, but it doesn't mean that a lot of these oil stocks that have run really, really hard. Now, the fact of the matter is, we've had one of the best earning, pre-earnings runs for the first quarter since 2009. This has been a phenomenal run the market's had. Energy's had a great run the last month or so. It's certainly reasonable for some of these areas to pull back in here, especially if the market starts to drift. So for CVX, we'll see in this case, it's a 12 May expiration. So we're out here a little ways. And it's not huge. The 2,800 contracts mostly bought the 155. And we look at 155 here, it's all the way back. But you could construct something more simple, maybe like an in-out spread, buying the 175, selling the 170. What does that look like? The skew is going for us about 253. Your break-even price will take 175 minus 253. It's about 172.50. We're currently at 171. So really all we have to do is stay at the current price. You'll make money on this thing. Or if we see a little bit of a decline, that should push this to a 75-cent gain within a few days pretty quickly. It's about a 30% return just on a small pullback here. Something that's an interesting setup on CVX. Another one here is Cenovus. So CVE is one of those companies. If we look at the Analyze tab and we go to fundamentals, I believe, so it's not going to say here, but I do believe they are more of an integrated company similar to CVX. We've seen some recent weakness here, but notice that we had the big flag pull run here, high volume, especially on the last gasp. We're pulling back to about the 50% retracement. This looks like a bull flag. So while some may experience some bearish pressure, some may have a chance for some bullish pressure. I'm actually going to draw this as a wedge formation, lower highs, lower lows, but converging. Either way, we're looking at this thing retesting the prior high at about 1920. And for this one specifically, and again, we've had bullish activity on it 2 times last week. I think Thursday and Friday. So I'm looking at my notes here. It might have been Wednesday. No, it's Thursday. Thursday and Friday of last week, we're seeing bullish option activity today, and it's in the June 22. So it's way the heck up here, but we're seeing just continued money flow, looking for a break, probably above yesterday's high as kind of a trigger here, breaking out of the wedge, looking at 19, but certainly if oil continues to strengthen, there may be a lot more upside in Cenovus. Let's turn our attention to some technology stocks. Hewlett-Packard. This is one that last week was setting up, I believe last Monday. It was a 14 April $30 strike price. Wasn't too far out of the money, and we hit that 30 pretty well, but we're breaking through it today, and we're seeing some 31 strike come in. Now, this is an area of resistance. We're at that strike price. So look at a break of 31 as kind of a trigger. Notice the higher lows. So if we're to back this out to weekly higher lows equal highs, the range on this is 26 to 31. They've already announced their earnings, $5, 31 to 36. So again, $36 price target in the coming weeks. And if we draw a fib on this from the high down to low, this is a fib retracement. Where does that get us? A 2/3 retracement's about $35. So probably looking at that, we kind of met the trend target back here. I'm going to remove that. But looking at this thing, this is our seed wave right here, projection, $35 in the coming weeks, maybe a month or two would be that potential target for Hewlett-Packard. Obviously near term, we're looking for something a little shorter than that, but 31 is that trigger level to break out. We could quickly get to 33 to maybe 35 here, 35 being in the upward. And if we break 35, then we're looking at 40. So again, watch Hewlett-Packard. Again, earnings aren't until out here in the end of May, so we have plenty of time for a bit of a run in the coming weeks. Now, the second consecutive Monday, we've seen bullish activity in Hewlett-Packard. TME, 10-cent music. Testing support once, twice, kind of gap through it, then pop back above 3 or 4 times here in the last month. We're catching a bid today off of support. Volume is about average. A near-term expectation, basically about $9, retesting the high of the range. And again, what turned my attention to 10-cent music? Again, a weaker dollar would help, stronger Chinese markets. But again, it's the option activity. So today in 10 cent, it was the Jan 17. So it's out here ways. but really, really significant. 28,000 contracts traded. And you look at today's option statistics, almost 90% of it traded at the ask, 30 times the average. So big stuff coming here for January. It's longer dated, but it isn't representative of flows. But so again, near-term strength, possibility to 9. Again, you can either shoot for the end of year up here or just play the short-term movement as maybe some attention's being drawn and some interest in 10-cent music retesting prior highs. Well, folks, that's all we got for today. I can wrap it up here. Hope you have a great one. We'll see you back on next.